All right, Apple's moving in-house. Recent reports make it clear Apple is continuing development of its own technology to replace everything from the wireless chips currently made by Qualcomm to the LG and Samsung displays its devices use. Joining us to discuss is Ruben Roy, Stifel Applied Technology Analyst. Ruben, good to see you here this morning. So why is Apple making this, and what does it mean to the longer-term margin structure for the company?
So thanks for having me. So Apple's been probably not slowly, actually quite quickly moving to bring more of its chips into a captive capacity. And the reason for that, as you said, is margin. So chip companies, there's a lot of value added in these chips. Qualcomm, Broadcom is a supplier to Apple for many years, and there's a lot of technology that goes into the chips. And with each iteration of an iPhone and each iteration of the cellular technology, we're up to 5G, obviously, moving to 6G eventually. These complexities cost money. So Apple is trying to increase its ROI, and one of the ways of doing that is to bring this very complicated technology in-house.
Any idea or ballpark estimate, Ruben, on what type of impact to the total addressable market for semiconductors a move like this from Apple might have?
Well, the semiconductor industry from a revenue perspective is quite massive. So I think in 2022, we're looking at a $400 billion industry, and Apple's a material part of the industry, but Apple is one customer. I think you have to look at the individual companies. So there are companies with a lot of exposure to Apple, Broadcom, which we do not cover, by the way, and so we don't have an investment opinion on it. But Broadcom does have somewhere around 15 to 20% exposure to Apple for total revenues. So certainly, if Apple were to take some of the technology that they acquire from Broadcom in-house, that would be significant. Other companies like Qualcomm, Apple is a little bit lower in terms of overall exposure. And then, you have to look at the supply chain. My guess is that this is going to take time, and it's going to come in waves, meaning that Apple has flagship iPhones, they've got iPads, they've got other technologies that they're working on that use some of the technologies that companies like Broadcom bring to the table. And these products have to get qualified across different networks, et cetera. So this is not going to be something that impacts companies that are supplying Apple overnight. But over the last 10 years or so, Apple certainly has brought in a lot more of this type of technology in-house, and that's a trend that will likely continue.
So, Ruben, to take a step back here, we're talking about this Apple challenge and the sort of rejiggering of suppliers. We were just talking a few moments ago about a drop in PC demand. We obviously know about the inventory correction that's going on in the industry. Are we going to see a gain in semiconductor stocks this year, or are they going to continue to have a really tough time?
We're on the latter side of that debate. We think that broad semiconductor markets, so when you look at the analog companies, et cetera, which is covered by Tori Svanberg here at Stifel, we're looking right now forecasting for 8 to 10% down revenue scenario for 2023 versus 2022. And that comes in two parts. One is units have been outpacing longer-term trends for quite a while now. Obviously, you folks know about the supply chain issues, et cetera, and demand coming back very quickly post the initial part of COVID with work from home, learn from home, et cetera. And so with units outdoing the trend line, we're expecting a reversion to the mean on that unit number. So units probably down somewhere in the teens. Now that's going to be offset by pricing. The semiconductor companies have enjoyed slightly higher pricing environment, more benign pricing environment than they have historically. And we think that's something that for now is here to stay. Supply input costs have gone up, and the semiconductor companies are getting a little bit more ROI. And again, that's one of the reasons that Apple is looking to bring more of that technology in-house. So when we put that together, we're looking for an 8 to 10% downtick in revenue for the broader semiconductor industry. Now, certainly there's companies that have exposure to PCs. You guys were talking about IDC and the fact that the PC market looks to be down 28% year over year in Q4. That's decelerating faster after a 15% decline in Q3. So for companies that have more exposure to PCs, certainly potentially the outcome could be a little bit worse than that 8 to 10% downtick that we're seeing for the broader industry.
And Ruben, for those companies impacted by Apple pulling its production in-house, how do they make up that revenue shortfall? What other markets could they look to?
Well, it's an interesting question. Some companies like a Broadcom have been diversifying quite rapidly. Broadcom's gotten into enterprise software, and they have other other areas like data center networking, et cetera, where they are diversified into. We've seen a lot of consolidation in the semiconductor industry, and that's likely to continue as well as companies try to diversify away from large concentrations of either customers or end markets. I believe that the semiconductor industry in general is going to have a multi-year growth trend that's going to be meaningful. Obviously this year is going to be a little bit difficult, but there are these mega trends that we've talked about and we wrote about in a recent report. When we look at 2023, for instance, AI comes up a lot. I think AI is hitting an inflection point. We've heard all about ChatGPT and how interesting that new technology is as it relates to AI. And I think Fortune 500 companies, enterprise companies are certainly tuned into that. We've heard a lot about the data center and cloud infrastructure build out, and that's something that's here to stay. We've heard about the automotive market and silicon content moving higher as we get into higher levels of autonomy and EVs. And so there's a lot of megatrends that are going to drive growth. So I think the companies that have exposure, again, to single companies or single markets are actively looking to diversify into some of these other areas that should provide nice growth over the next decade.
So, Ruben, if we look at each of those three trends, just briefly, what would be your top picks among companies that are best poised to take advantage of those, starting with AI? And again, just as briefly as you can.
Yeah, just briefly, AI. Right now, we like AMD as an AI play. NVIDIA is obviously the other choice. NVIDIA is trading at a little bit of a higher valuation, but we have to pick one just on valuation. We think AMD lines up really well with the trends that we're going to see this year and in the years to come in AI. And that's one of the ones that we're recommending to investors to look at.
And just lastly, Ruben, while we've got you, when you think about the overhang that U.S. and China relations have been on the semiconductor space, do we see any of those issues solved for or abated this year?
I don't think so. I think this is going to be an ongoing issue. And I think it's an area that is going to take multi-years to come to a conclusion on. I think in the meantime, one of the benefits or good things that's come out of the geopolitical tensions here is that we are going to see some more onshoring of semiconductor manufacturing in the United States, which I think is a good thing. I think a lot of the companies that we just talked about have a lot of exposure to certain geographies of the world, and I think having a diversification away from single areas of manufacturing is a good thing for the industry and these companies specifically longer term.
Ruben, good to catch up with you. Ruben Roy, Stifel Applied Technology Analyst on the outlook for chips and beyond. Appreciate it.
Thank you very much.